Okay, taking a look at gold here again, it's still doing its consolidation. Nothing has changed. The reason I think the Fed is going to make a mistake, and again, gold is not a hedge against inflation. It's a hedge against the Federal Reserve making a policy error. The policy error specifically I think they're going to make is they see the price of crude skyrocketing, and they're getting now for the first time ever pushback from the administration about tamping down inflationary pressure because people are getting angry at $25 a pound ribeye. So the Fed is going to, the gold signal hasn't yet told them that they're doing too much quantitative easing, that there's too much money. Okay. So I think they're going to try and, I think they figure gold is in this range right here, $1,000 to $2,000. So they think it's fine. If they take away money, gold is going to go back down to 1,000, and that'll be their signal that it's okay. They've managed the money. There's no breakout in inflation. There's no deflation, and they're fine. I think that's what they think. And they're going to do 5 hikes by March of next year. Fine. I think the issue is they are severely underestimating, first of all, the demand for cash and how much liquidity the real world economy needs and the market, the financial assets need to maintain current prices. So you see some of that price coming out of PayPal and everything, and a lot of the hot tech stocks, but the indices are, still right on highs, so they're fine. So the Fed is looking at all that. The Fed is not looking at PayPal or Facebook or Amazon or anything. They're looking at the indices day to day. Indices look fine, so they think that they're okay to go ahead with 5 hikes this year by March. We're fine. The problem lies in that, there's a lot of demand for cash. So a lot of boomers now have a bunch of money and they have equity in their houses. Well, they want to do X and help their kids buy their first time houses with the down payment. So they're taking that equity out of 3.5% with no penalty for early repayment. So they're demanding all this cash right now before interest rates go up. So there's a lot of demand for cash. The bank's got to get that cash from somewhere. So it comes from the financial asset system, the financial asset marketplace. So that's got to come out of either stocks or excess reserves or somewhere. That cash is coming out and trying to buy real world goods and services, trying to buy cars or real estate for their kids or redo their own homes as they get older and start making it more livable. Okay, getting back to their policy error that they're going to make is underestimating the amount of liquidity. I think that's why gold is just hanging out here. Everyone is waiting for them to hike. Things seem fine, but then something goes wrong, right? There's not, you already saw what happened with China when they tried to do Evergrande. They tried to take liquidity out because they tried to rein in the tech stuff over there, and then their markets needed liquidity, and they kind of managed it though. Evergrande, their whole real estate sector went up, but they're dealing with that, and they already cut rates. So but they have a different kind of system over there. So I don't know if the Fed's going to be able to just do 5 hikes and everything is fine. It's getting shorter and shorter and shorter the amount of time between when they can kind of try and cool off and then when they got to pump back on the gas. So I don't know, maybe it's 3 months, maybe it's March. We go down until March, and then this thing kind of takes off when they got to reprint, redo QE. Maybe we're looking at a March time frame for any kind of possible development here. And so specifically, I think that's the policy error that the Fed is going to be forced into walking into. They're just going to walk right into it because they're going to have to put more assets on their balance sheet. So they're going to have to provide liquidity to the world because who's going to do it? You know, I mean, who's going to do it? There's nobody else out there that, you know, nobody else transacts in any other currency. So, in a large way. So it's got to be them. They're going to have to be the ones, or some conglomerate of central banks is going to have to step up and they're going to have to do something with the BIS. But they're going to have to take if they don't want asset prices going down, which they can't have because that's kind of their job is to maintain liquidity as what they see fit, insofar as that doesn't interfere with inflation, with CPI, with the cost of goods and services. So they've tolerated, rising service sector jobs and payments in the service sector and education and stuff like that, education and healthcare. They've tolerated that inflation for a couple, like a decade and a half now, and people haven't gotten really pissed off. And now they're running into $25 a pound ribeye, which they tend not to tolerate, and 90 something dollar crude oil. So they kind of start to get upset at $100. So they're going to tighten, and I think the problem is now they're going to see the long end take off once they do 5 hikes, because that's going to get them right to 2.5%, 3% anyway. And so we know that the excess reserves in the system is what triggers these financial crises. So it's about 2 trillion. If there's at least 2 trillion in excess reserves in the system, everything's going to be fine. As soon as they stop publishing this number, because everyone figured it out. That's what happened in the repo crisis, Christmas of 2019 or 2018? Yeah, 2019. 2 trillion. Once excess reserves dips below 2 trillion, we have a financial crisis, and then they have to come in and restart QE. So they stopped publishing that number once, it was made obvious that that was the trigger. That's what's setting off these crises is 2 trillion in excess reserves being breached to the downside. So I don't know what it's going to take to get one of these kind of moves. But in excess reserves, they're going to have to add a bunch to the whole dollar system. I mean, the euro dollar system, everyone. They're going to have to put everything on there. The problem is the crisis that's going to have to happen in order for them to blink and do that is probably immense. I don't know. Maybe it's not so immense. Like that COVID crash wasn't really a big deal. I think we just went down 20% and they instantly flipped and started doing, buying everything. So, 20% seems like the downside for them which isn't that far away from wherever, 4,500 on the S&P. That's nothing. So we're going to go into this error, and then and only then can gold actually do one more of these kind of huge moves.